Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young, and today is February 27, 2025. And we're going to talk about good news being bad news being good news, or more specifically, bad or negative news being positive for some sectors. That's what we're going to focus on, is how some overall economic negatives can be positive for specific sectors. And we're going to start with the discussion of crude. And crude oil, as you can see through here, had crude oil inventories this Wednesday. And this number, the actual number, came in negative, but they put it in green. And so this idea that when you see a negative number, the crude oil inventories decline, not only did they not add more inventory, they drew and pulled inventory out. So they pulled a net inventory of negative 2.3 million barrels out of the inventories for business inventories. So this would be seen as the businesses that have access to oil inventories, these businesses are pulling those out and selling them. They're using them or selling them. And that would be a sign of need, desperation, and drawing down those inventories is actually negative. It's actually not a positive sign, and the number is negative as it shows here, but it's positive for crude. So the companies that are crude producers and involved in energy are going to benefit from the fact that we have less supply and apparently more demand to put a negative 2.3 million barrel drawdown of inventories. So that's the first thing we're seeing, is that negative number is positive green. It's green positive for crude, but negative as an indication that we have less supply and more demand. And so therefore oil prices should go higher. Benefits oil companies and energy companies like ExxonMobil, ConocoPhillips, Chevron, but probably negative for the consumer. Which brings us to the next thing we're looking at. We can see that as we look down at the data in inflation data, we're going to look at this number here, and this is the preliminary GDP price index. And so they're looking at this number climbing as a positive number, and when it's the price index, that tells you that things cost more. Generally speaking, for the economic conditions, increasing pricing, inflation that's in a certain range is usually seen as positive. So here we have something that is positive again in the data, in the numbers, that would help the currency, help the growth of the economy theoretically if there's high enough demand and low enough inflation. But tomorrow we're going to get inflation data, which is what the Fed loves to focus on, and that is PCE. So the personal consumption expenditure data is expected to be increasing and showing that things cost more. Consumers are spending more money because they have to, not because they want to. They're spending more money because things cost more, and that price index and what we're seeing here in the PCE price index is expected to go higher. And so we're seeing year over year and month over month increased costs. Inflation is still here, and growth itself is stagnant. We're just stuck here at 2.3. So inflation is going faster than growth in GDP. That is not a positive sign, again, for consumers, but an indication that things are cost more and growth is slow or stagnant. And we can get one more confirmation in that consumer confidence is sliding and fading from a peak of 104, sliding back to 98. And that's not a huge drop, but it is definitely showing that the trajectory of the consumer's confidence and hope and feeling of confidence in spending is probably on decline, which is why I am looking very specifically for trades to be bullish in energy and bullish in consumer staples while getting rid of the overpriced, overinflated, way too high price to earnings ratio stocks like the technology sector, including Nvidia, Broadcom, Microsoft, Oracle, CRM, Salesforce, Intuit, and others. So right now, this is for me a sign to yet again go into safety and go into energy. Before we get to the specific sectors, let's just highlight really quickly that we've absolutely put in a bottom, put in higher highs, higher lows, and have recovered from bonds perspective as a flight to safety all the way back from all of February, all of January, and almost all of December, putting us back to the peaks of December in this last month and a half. So we're seeing a flight to safety and rush into bonds, avoiding equities and into bonds, while equities are going into this holding pattern. If we look at the technology sector, which I'm not going to talk about bearish trades in technology today, but I am going to just highlight how aggressively bearish that has been from the peak to the trough and that sell-off. And the broad sector, not even individual stocks that are a lot more dramatic, but the broad sector has erased about 7.5%. And if we break through this low, it should duplicate that as a rectangle or a triple quadruple top, and that would bring us all the way down from peak to trough about 15%, and that's going to be a sign that we're going into a correction and into a bear market potentially, at least in technology. But as we're watching this, we look at crude prices and we look at inventories. Energy is consolidating in this big long-term pattern. This is a bounce up near $68 prices in oil prices, which is an area that I find there's strong support. And if we break free out of this consolidation, we could see energy spike all the way back up to 98. If we look at individual stocks inside of energy, like ExxonMobil's break above 112, 113, should see this repeat and get up to 118, and I'm even looking for 123 on ExxonMobil. If we look at ConocoPhillips, ConocoPhillips is near support, has further to go to break horizontal resistance, but I'm just looking for this to break out of this consolidation, which is steeper, and therefore I'd only be looking for a break of 100 for a 5% move, and then potentially a 15% move to return back to November and December highs. So there's multiple stocks in this area of energy that are setting up for breakouts and bullishness, while the rest of the market is going into a holding pattern or flat out bearishness. And I think energy is priced in a way that they have been able to maintain their margins even as price pulled back to the low 70s, high 60s, which should help the energy sector maintain, especially if oil bounces as it appears it has done today. So watch for those to break out and continue to move higher. As far as the consumer is concerned, higher oil prices, higher costs here will feed into how they spend. And one of the few sectors that are positive today, we have energy, we have finance, we have consumer staples. Everything else has been pretty negative. And so if we look at consumer staples as a flight to safety, similar to the way we looked at bonds just a minute ago, we already made a higher high. We already broke the downtrend. We've now retested the downtrend in a gap down close up. If you joined me when we talked about gaps and single candle patterns on Tuesday, this exhaustion gap has already filled. As long as it closes above 81.96, well, 82 is the actual close price, 82, it should be able to maintain the move up here to 84. But again, I'm not looking for just trading the broad sector. This is where I would look for individual stocks inside of consumer staples and continue to look for those opportunities in stocks like Walmart, Coca-Cola, Procter & Gamble, etc. So let's go through a few really quickly. And Walmart, you can see, has defended its support level, retested, pulled back. If we can clear 97, I believe we're going back to retest at least 105, and we're looking for about a 6 to 8% move to retest those highs and continuing to step higher and higher in these channels. As we look at Coca-Cola, as you know, one of my favorites as far as dividend aristocrat stocks, we talked about buying Coca-Cola all the way down here at 61 and 62, and then we had a huge break on earnings. At this point, if we clear 71, 75, we should be able to get to 73. It's not a big move, but it does set us up for new 52-week highs and continue to get paid a dividend on Coca-Cola, as Coca-Cola still is paying a 2.85% dividend even at $71 per share. If we look at Procter & Gamble, Procter & Gamble also poised to close higher when the rest of the market is down today, 1.5%. Procter & Gamble is up 0.64. It has created a widening candle, as we discussed on Tuesday. In Tuesday's main room discussion, we talked about a widening pattern is a increased volatility, and if we want to use that as a confirmation of engulfing this previous candle, this is a bullish entry. The risk you'd have to take is only about $2 for the potential to go 8. So this becomes a 4-to-1 reward risk ratio to trade Procter & Gamble back up to its swing high. And this is not the only ones. There's multiple stocks that are setting up for these very bullish moves and bullish breakouts inside of consumer staples. I would love to say I have a strong trade in Costco because I love Costco. I think it's a good company. We just haven't stopped falling yet here, so I would like to see this stop falling or at least defend the 1024 and be aware that we do have earnings coming up on Costco on the 6th. So I would love to be able to set up a trade on Costco, but it's not quite there for me yet. So watch for that and watch for that bounce and to move higher. But you can look at some of the other stocks inside of that. We already looked at Procter & Gamble. Let's go to Colgate, Colgate-Palmolive. And as you can see, gap down, close up again. That's an exhaustion gap that, as far as bearish, is exhausted bearish, so it wants to go bullish. We already put in a new high. So for me, this could be treated as a bull flag, and Colgate could move this bull flag height from 85 to 93, and therefore a break of this downward trending lower highs through here could see an $8 to $9 move, and I'm looking all the way back up to 100 for Colgate-Palmolive. Let's do one more consumer staples, one that maybe, well, we should have talked about more, I guess more frequently, but should have been talked about in conjunction with the bird flu, and that is Tyson. So if we go to TSN, Tyson Foods, big chicken producer, you can see that we've already priced in all the bird flu, all the reduction of bird populations that have happened this last year. Whether you noticed with all the egg prices, maybe you forgot that we also have chickens, and chickens have already been knocked down, and Tyson has lost quite a bit through here. But then we started creating a clean, established higher low. It doesn't take very long to rebuild these populations with how fast these chicks grow up to be full chickens. And so as we're looking at this, we had a consistent recovery here post earnings. They still made good money, and as we're pulling back through here, this to me is another bull flag type pattern where we rallied up and we pulled back for the last 3 days, lower highs. But today is that gap down, close higher reversal. And this flag goes from 56.50 to 61.90 roughly. And so I'm looking for this to give us another 10% move and push us back to 66, if not higher. So Tyson's providing us with nearly a 10% potential move off its little bull flag. And we're seeing bull flags and recoveries and bullishness in consumer staples almost across the board, despite the fact that U.S. equities are continuing to slide as we go into the end of the day, where the NASDAQ is approaching a 2% decline for the day, and technology is continuing to being weighed down as NVIDIA no longer is apparently going to save the market. NASDAQ down 1%, S&P broadly is down 1%, and the NASDAQ down 2%, excuse me. And what we're seeing is that we see the safety being pushed into consumer staples and energy, and some of these stocks are up over 1%, while the broad market is down 1 to 2%. This is where we're going to find safety. This is where we're going to find opportunities to be able to continue to trade bullish, continue to buy, collect dividends, and grow as consumers adjust their spending habits and the investors focus on the safest diversified positions inside of consumer staples and energy. That's going to do it for me today. Join me again tomorrow morning. We'll talk about PCE, personal consumption expenditure, and inflation data, as Brandon and I look at opportunities going into the next month of March. Otherwise, we'll see you in the morning or next week. Take care.